Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Monday expert, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Nice to see you as well. So one of the things I wanted to ask you, because again, you called the great deleveraging or the pain before it started. So kudos to you. Obviously, a lot of that has kind of been the balloon's been pricked by the Fed in the acknowledgement that they will start raising rates. I am a student of economic history. And we have beaten inflation before, a la the 80s and Paul Volcker. What a lot of people don't understand is Paul Volcker beat inflation by taking the front end or the Fed rate above inflation. Back in the day, he took the last print, I think, on inflation was roughly 15%. He took it all the way to 20%, the Fed funds rate. I'm not calling for 20% today, but I'm just acknowledging that in order to beat it, he had to encourage savings and stop spending and lending and all of that. So my question to you, do you think Powell can raise the front end above inflation in today's environment with all the debt in this country?
Yeah, they can. The question is, will they? And, what would be the result if they did? But yeah, they could absolutely do it. I'm just not so sure that, they have the backbone to do that and to stand behind it and let the chips fall where they need to fall. The pressures are, like you said, there's so much debt that they have on their balance sheet because, the government's borrowing money through the issuance of bonds that it would get too expensive to sustain the debt. But, if we're printing money, just print the debt payments and, you just print the money to service the debt. So, the philosophy of we can't service a high interest debt just doesn't make any sense when you're just printing money. So, the real issue too that we're facing is, and we still don't know where inflation is going to fall. I mean, some of this is going to be transitory, some of the things that we're seeing, but overall, inflation is here for the longer term in a lot of areas, in a lot of ways. And as far as, the liquidity crisis, this is a liquidity crisis. It's global. It's not just the United States, it's global. So one country, the ECB just raised rates the second time. They've got the same issues we do. So do other countries around the world. One country changing policy too fast, too aggressively can trigger, a collapse around the world. And that really is the conversation. So what happens then? Well, that's when, ECB, the central banks and governments all sit down around a table and start taking haircuts. And, that's when you start working out debt around the world, where your sovereign nations that own each other's debt sit down and just start having those conversations and saying, look, who's willing to take the first cut? And that's what happens. Somebody asked that question. What happens if it gets to the point to where our debt is unsustainable? Globally, we're having an economic meltdown. What happens? And that's what happens. Just like a bank, when real estate was collapsing, countries and banks, they sit down in a room and they work it out. And that's really all you can do.
Wow. So when I look at this, because I knew I was bringing this topic to you today, if you take out the transitory aspects, I personally assume inflation, removing all the noise, certainly over 4, could be over 5%. And that's, that'll be by the summer once the base effect is removed kind of in April or May, which is just it's happening. Anyways. So if that's the case, I'm thinking, let's say it's 5%. Can the Fed get to 6.5 on the front end? And I play that out. I'm like, okay, if the Fed's at 5 on the front end, that means, mortgages are 7.5, 8, and then that's mortgages, right? And then car loans and all these other things. It gets really, really messy, really, really fast.
And, that's the problem, because that used to be a great rate, where we are now is just, I mean, where we are now is just unfathomable 5 years ago, 7 years ago, from where rates were and where we came from when, things were going well and we were having issues globally, and we had to, because of the housing crisis, and we had to unwind everything. And the only way to do that was to artificially pump up markets around the world and economies around the world by keeping rates low, which encourages borrowing, which encourages spending and things like that. So now we're on the back end of it. So it's very tricky. And a lot of people are like, well, why is the markets freaking out over a potential possible 0.5 point rate cut? And it's because what the Fed said, what Powell said, we have a lot of room to raise rates given a strong economy. So what the markets realize is Powell actually thinks that the economy is strong. And they don't agree with that. The
Yeah.
bond markets, investor markets, investors do not agree that the economy is strong enough to sustain any series of rate hikes like he's talking about. So we'll just have to see. Yes, they can do what they need to do, but they are going to be limited, because if they start destroying wealth, that's a big problem. If rates go up, people's borrowing power is limited, credit markets start to dry up, people spend less money, they don't invest in infrastructure to grow their businesses. So all of that deflates, and then you get stagflation, you have high, inflation, you have rates rising, and you get stagflation, and that's just a recipe for, not a very good outcome. But at the end of the day, nothing is, I don't think you're going to see a depression, right? We're just too big of an economy now. We're global. You got to have basic goods and services to live, which is going to create so much, money velocity in the economy around the world. So yeah, I don't think you can see depression as we know it, 1929 style, where there's just no jobs, there's just nothing. I mean, the economy can tick along and do extremely well right now, just because of the way we all work and live and consume now.
Yeah, I'm actually, again, sitting here January 31st, call it February 1st, thinking stagflation is the best we can hope for this year. I think the economy is far weaker. I think, I don't know if you saw this, but the Q4 GDP numbers, everybody was happy about. I think they were 6.9% if memory serves. Almost 5% of that, or almost 75% of that increase, was inventory build. I've been doing this a long time. What happened in Q4 is buyers couldn't get stuff. So instead of just in time, they started just like triple, quadruple ordering. I'll take whatever you have. Give me, give me, give me. Guess what? That inventory is going to show up. It's going to sit on the shelf, and then we're going to have a sale because there's too much. The economy is not nearly as strong as some of that data shows, in my opinion. Is that?
Yeah, the PMI index is important to keep an eye on and kind of cross-reference that, with inventories, transportation, things like that. But yeah, that's the conversation now is, are these inventories built up now? And Peter Schiff just said something about that the other day, and something that we have to work through over a number of years. But there's still a lot of demand out there. There's still a lot of consumption out there. And as we saw in the pandemic, even with shutting down and, 20% of the workforce being laid off, we still ticked along pretty good. So it's a different time. It's a different animal. So it'll be interesting to see what is this really all about. But there are the sectors that were really thriving that, we're not going to see as much activity in, home improvements, things like that. Everybody went to Lowe's, right? Because they couldn't do anything else. Everybody was working on the home office. So there was a lot of expenses there. So a lot of these, a lot of the COVID play growth is going to be, non-existent here moving forward, especially once we get through this and start opening back up and people start traveling abroad and things like that. So it's really interesting times. I mean, nobody knows for sure. But what we do know is inflation is real. It's here. And a lot of the people at the Fed are kind of denying it. I mean, I think Kashkari came out and said, no, we need to keep the pedal to the metal, and we don't need to stop now. And I mean, it's just really interesting how a group of individuals can sit around a table and deny, what is going on and not take action like right now. They didn't even stop the taper. I mean, the bond purchasing, they haven't even started with taper. They should have just said, we're not purchasing any more bonds. Done at that meeting. They should have just called that and then said, we're raising rates and we're going to start reducing the balance sheet. That's the other question. Can they actually reduce that balance sheet, and how fast can they do it?
That's the one that I think freaked the market out. I think everybody anticipated them finishing the taper in March. I think nailed it. I think everybody anticipated rates going up in March. I think the little half point that I've been calling for is now probably going to happen. But I think what really freaked the market out is just that, is now they're going to become it's not quantitative easing, it's quantitative tightening. And again, I went back and researched 2018, last time they tried to do it. And it's all theory, man. They don't know how to do it. And I think that's freaking the market out.
Yeah, it'll be interesting to see because, as they start to unload the bonds that they have on their books, I mean, that just drives, rates up and creates competition because there's dollars coming out of risk assets, stock market, cryptos, Bitcoin, things like that, going into more stable assets that they see protection in with an unstable global economic climate out there. And, with conflict on the horizon, things like that, there's a lot of uncertainty that investors are looking for a safe place to put capital right now and to get, a basic yield to kind of hedge a little bit of that inflation burn right now.
Yeah. So I guess kind of answering the question that I opened with, can they raise rates above inflation? You're right. They can. The other point being, do they have the stones or the backbone to do it? I don't think so. I think they raise rates, they get it over 1.5. Again, the front end, the economy proves to be weaker than they thought, and then they become afraid. And they
Yeah, and
back
to
off.
that point, if they did come out and put rates all of a sudden at 5%, that'd be it. I mean, you would see a global economic meltdown instantly in all
Yeah.
markets, real estate, stocks, cryptos, everything. And you're already starting to see it in real estate. I mean, mortgage refinance demand is way down.
Oh yeah.
Even just with this little bit. And what I tell you before, so just like I said back in November, it's really funny. The Thanksgiving conversations where everybody's getting around the table trying to get all their family into crypto and all that. I was the opposite. I'm like, get out. The market's topped, sell and wait, and then buy back in later when the dust settles. So, I talked, that was my Thanksgiving dinner conversations. And you and I have been having those conversations probably October. I think I started to really, something's not right.
Yeah.
And, go there. But, it's really interesting. So what I was getting back to was, that 5% in terms of the damage that would do to markets, to real estate, things like that. I mean, it would be pretty catastrophic across the board. And you and I were talking before, this is the point I was getting to, was that, 4% is the number now in the real estate market. If interest rates get to 4%, you will see the market just kind of go ice cold. I'm not saying it'll crash. I'm not saying all that.
Transaction.
I'm just saying that's when prices reset, inventory levels rise, and the correction in the housing market begins. You get out of the threes, housing market is done.
Yeah, just so you know, the investor loans, I have a mortgage guy on every Wednesday. Mortgage loans are about 4 3/8 now for standard investor loans. Homeowners still about 3.8, 3.75, 3.8, somewhere in there. So getting pretty close to that 4%. For me, the number's always been 5, but it's the payment's certainly going to change. Affordability is going to go down. It's going to be an interesting time for sure.
Yeah, it was 5 last go around, 04, 05 and 2008, 9. That was your threshold. Now the mental psychological level is 4%. You get rates over 4. Psychologically for people, that's just unthinkable, which is still incredible. I mean,
exactly. It's crazy.
Yeah, there's still, that's what's so mind-boggling about what the Fed has done, what central banks around the world have done in terms of where we are from, monetary policy, that a 4 or 5% rate would be so damaging. That's just incredible to think about.
Yeah, it is. It's phenomenal, especially as the guy's first loan was 7 and an 8. Pretty crazy. Well, Greg, you do amazing stuff all the time on your YouTube channel. How can people find you?
GregDickerson.com. It's all there. YouTube podcast. Go check it out.
Thanks, buddy.